Have you ever been told that saving money is the key to becoming wealthy? It's advice we've heard since childhood. Save your money. Don't spend too much. Put something aside every month. On the surface, it sounds perfectly reasonable. And to be clear, saving money is important. An emergency fund can protect you during difficult times. It gives you peace of mind and financial security. But here's the problem. If your entire financial strategy is simply saving money, you may never build real wealth, because money sitting still doesn't grow. In fact, every year, it quietly loses value. Inflation slowly reduces your purchasing power. The money you save today will likely buy less in 10 or 20 years than it does right now. Imagine two friends. Let's call them Alex and Michael. Both earn the same salary. Both live similar lifestyles. Both decide to save $500 every month. Alex puts his money into a savings account. He feels responsible, safe, in control. Michael also saves $500 every month. But instead of leaving all of it in cash, he invests a large portion into diversified index funds and productive assets. At first, nothing seems different. 1 year passes, then 5, then 10. Alex proudly watches his savings account grow. Michael's investment portfolio rises and falls with the market. Sometimes it's stressful. Sometimes it even loses value for a while. But Michael understands something that Alex doesn't. Money should work for you. While you sleep, businesses continue operating. Employees build products, customers buy services, companies earn profits, and investors participate in that growth. 20 years later, both men look back. Alex has a large savings account. Michael owns growing investments that have been compounding for decades. The difference isn't how much they earned. The difference is where their money spent its time. Saving protects money. Investing gives money the opportunity to grow. This doesn't mean you should invest every dollar you own. A healthy financial plan starts with a solid emergency fund. Pay off high-interest debt. Build financial stability first. Then allow your long-term savings to work harder than inflation. One of the biggest mistakes people make is believing they need thousands of dollars before they can invest. The truth is much simpler. Small amounts invested consistently over many years often outperform large amounts invested too late. Time matters more than timing. The earlier you begin, the more powerful compound growth becomes. Think of investing like planting a tree. The best time was years ago. The second best time is today. Every month you wait is another month your money isn't working for you. Building wealth isn't about getting lucky. It's not about predicting the stock market. It's not about finding the next millionaire investment. It's about creating simple habits that you can repeat for decades. Earn, save, invest, repeat. Financial freedom usually doesn't happen overnight. It grows quietly through patience, discipline, and consistency. So the next time someone tells you that saving money alone will make you rich, remember this. Saving money protects your future. Investing builds it. If you found this video helpful, consider subscribing for more practical lessons about building wealth, improving your financial habits, and making smarter money decisions. Thanks for watching, and I'll see you in the next video.